presentation contains current opinions of Moez Ansari, Chief Investment Officer of Compact Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Mo's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Mo.
Hello, everyone, and welcome to the Compact Market Wrap YouTube update for February the 17th, 2026. I'm Mo Ansari, President of Compact Asset Management, and thank you for joining me today. First of all, a quick reminder, click on the subscribe button so whenever I post a YouTube update, you'll be notified, or you can go to the compact.com website and click on Insights, and that you can listen to the podcast, look at the YouTubes, and all the information that we have there. If you need information on your portfolio, would like to get more updates, or need some help on your portfolio, send us an email at invest@compact.com or just give us a call at 800-388-9700. Let's start with the numbers. Last week, market was down 1.35% for the week. The S&P, the Dow was down 1.15%, and the tech continues to drift lower, down 2.08%. It is down 2.95% for the year. That's about 3% pullback. Dow is still up 3% on the other hand, and the S&P is flat for the year. So market's sort of digesting the big move that we've seen in the last quarter of last year. Let's take a look at the sectors: utilities, real estate, materials. All the sectors that were down last year are coming back up, and the sectors that were leading last year, technology, consumer discretionary, communication services, and financials, were down big last week. So it's sort of, market is diversifying. It's sort of moving away from the gains. They're taking some profits in the tech sector and moving those, and we're just seeing a reallocation of the market, and market going towards assets that are undervalued more. Utilities are not, but real estate, materials, energy, those are the ones that did not do well. Oil continues to move up on heightened tensions in the Middle East and with Iran. There were talks today, no conclusive conclusion there, but we are moving forces into the Arabian Sea and next to the Gulf of Hormuz, next to Iran. So it'll all depend on how things turn out over the next couple of weeks. I don't think that we want to go to war with Iran, but at the same time, we want to make sure that the Iranians do not develop a nuclear weapon. So it's a back and forth, and it's typical Middle East politics. We did see a big drawdown in interest rates. They went from 4.22 to 4.04. That was a big move to the downside in interest rates, which is sort of, as long as we stay between 3.9 and 4.25, I think we're okay on the 10-year. We have seen big inflows. You can see that the money coming into the gold ETF, GLD, has gone up dramatically, and that's the money flow. If you look at the last 15 years, this is the highest flow. We broke out about here, and then from there we've gone straight up. So there's a lot of money flowing into the gold ETF, as what we've seen. When the markets are at this evaluation, we see pullbacks, and that's what we're going through right now. I did come out, that's the inflation numbers lower than expected at 2.4%, and that is a good sign overall. It gives the Fed some room to bring rates down. I've talked about Warshonomics, which is my term for the new chair, Kevin Warsh, and I call it Warshonomics, and you'll hear that term, I guess. I started talking about that a couple of weeks ago. I think we're going to see that, where he's going to cut back in QE. That means he's tightening rates, but at the same time, he'll bring interest rates down, which it means he's loosening interest rates. The overall will be not much of a change, but it'll be a change in perception that the Fed is lowering rates, and that will make the president happy, as he has said for a long time. Retail sales came in flat last week, and that's what we're looking at. The big number next week will be fourth quarter GDP. It's expected to be around 3%. It was an incredible number that we saw the quarter before, which was 4.4%. The economy is really roaring. I think we expect a little bit of a slowdown there, but 3% is still a very good number for the S&P if we get it on Friday is when it is expected. Looking at the technicals of the market, we've sort of drifted this might be a fifth wave. My target was still right around here, but it did get above the third wave, and that is qualifies as a fifth wave. Seems like we were started. This seems ABC 1, 2, 3 to the downside. I still think this is more an ABC correction rather than a pullback. If we do get much below, 6,800, then I would start to get a little bit worried, because that's been the support area in the market. We've been in this channel sort of going back and forth right around here. Break below here, which was the December low, then we could come down to somewhere around 6,500. 6,511 is the 200-day moving average, and that's close to right about here, which was the November low. So from where we were around 7,000 down to 6,500, that's about somewhere around a 7-8% pullback in the market, and I would not be surprised if we break below 6,800. We were 67.75 this morning. We were down to this level, then popped back up from there. We're at 68.55. That's where we're trading right now. Same thing, 68.24 is the 20-week moving average. We're sitting right on it. Break below that takes us to somewhere around 63.50, which puts us at the 50-week moving average. I think that's more around 64, 6,500 by the time we get there. NASDAQ also breaking below the 50-day moving average, below the 20-day moving average, heading towards somewhere around, right around the 22,000 area. We're 22,645 today. We were down to 22,250. This is 21,800 is the 200-day moving average. We've seen more of a pullback in the tech and the software sector as people sell off some of those stocks that have had a tremendous gain over the last 2-3 years. And we're starting now to see the impact of AI on certain areas of tech, especially software. AI can do a lot of the work that software used to do. And that is sort of reallocating. People are starting to try to figure out where the gains are going to be because of AI, and who is going to be, what area is going to be negatively affected by AI. So I think this will take a year or two to sort out exactly what is going to gain and what is going to hurt. 20-week moving average here, we are below the 20-week, headed towards, which is again the 50-week, which is right around 21,000. The dot plot is something that I watch. As I said, when it turned up last April, that we could see as long as the market is above these dots, it is positive. But when it turns negative, the dots get above these. This is the market, these vertical lines. When the dots are above it, it is in a negative phase, and that's where we saw last year's Liberation Day sell-off in the market. If we get below this, which is right around 2,200, 22,000, that would not be good overall, and we could see some move down to 21,000 or even below that. That would not surprise me in this. So I would be watching right around the 22,000 number very, very carefully, and we're at 22,642 today. Once we turn negative, the dots get above. You can see this, each one of these dots is 1 week, and we can stay negative in the market, as it did right here, for quite some time, 2-3 months. So if we get below 22,000, that would not be a good sign for the overall. The small caps continue to do well. Came to the 20-week moving average last week. 20-day moving average bounced off from there. But we seem to have completed a fifth wave. So we'll have to see if 129 holds. We're at 131 today. A move below 129 could be slightly negative for that. So the international stocks continue to look good. This is the international MSCI daily chart, and we're starting to see a movement back and forth here. But again, it is fully valued. Interest rates sharply lower. They fell off from this area, 4.33, which was the high that I was looking at, 4.35 right here. We broke below that, broke below the 20-day, the 200-day, the 50-day, the 20-day, and now we're heading towards this area right here, which is right around 4%, and then 3.95, which was the October low. So we'll see how we went down last week, came back up today. We're trading at 4.05. We were at 4.02 this morning as the low, which was also last week's low. So interest rates are backing off as the market starts to soften a little bit. Gold market, below the 20-day moving average today, trading right around 450. 450.458 is the 20-day, 50 days 425, and then right here is 355, which is the 200-day. I would not be surprised to see a test of this, and if you break 425 on the GLD, which is the ETF for gold, you can buy gold in your stock portfolio simply by buying GLD. It's much easier to get out, much easier to get in. You don't have to pay the premiums if you're buying physical gold. You don't get the gold price. You get a price. You have to pay a premium for the coins or the bars, and you have to make that up before you can get back to even. So it's much more efficient to buy gold as a GLD, which is gold warehouse receipts. That means you have gold sitting in a warehouse. Now, people say, well, that might not be there, but it is audited, and I think this is a much more efficient way to participate in gold. The high yield ETF also below the 20-day, which is 80.86, trading right at the 50-day, which is 80.81. So we will have to wait and see how low interest rates go and what happens to the high yield bond. Those are my thoughts. Those are my observations. If you want a more detailed view of what we're looking at, go to compact.com, click on Insights, and listen to the podcast. That is a much more enhanced view of this YouTube update. If you want to subscribe to this YouTube update, click on subscribe. You'll automatically be notified. If you need help with your portfolio, send us an email at invest@compact.com or just give us a call at 800-388-9700. Those are my thoughts and observations for this week. I will be back with you next week. Until then, good trading.
This presentation contains the current views and opinions of Moise Ansari, Chief Investment Officer of Compact Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compact Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that overfocus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.